Official.
Okay, we're gonna let you play.
How's everybody doing? Good. I'm Adrian. Everybody has to know how to spell my last name, Lufchinoski, by the time the presentation's over. Wow, lively crowd. I'm here all week, folks. Love you guys. Drinks are free.
We're the same. I sat down so we could be the same height.
A little bit about Thrive before we jump in. Real estate company started in about 07, 08. You can imagine what raising capital was like in 08. It was, I like to say, character building. We have two methods of real estate that we focus on. We lend and we also buy, mainly multifamily. But I think the two go hand in hand really well. One, because if you're a real good lender and you start buying things, you understand how properties operate, then it makes you a better lender because you know where the pitfalls are and you know what some of the challenges are. You can't always buy and you can't always lend. When capital is plentiful and really cheap, we have a tougher time lending because our rates tend to be a little bit higher. When we're not buying, the lending fund, as right now, is really crushing it. We're doing really well and we're getting opportunities that we wouldn't normally get. So having both is quite effective for us, and having a banker's perspective is always fun to see how different from a banking perspective, how things look. We both happen to be deal junkies and we love looking at deals and getting creative. So that's a little bit about Thrive. Justin, you want to introduce yourself?
Yeah, Justin Bronya. I've been with Adrian and our partner JP, I guess about 8 years now. As Adrian mentioned, my background's banking. I kind of grew up in the banking world, started as a teller when I was in college, woke up one day, was president of a bank, and then a couple years later, Adrian got me to defect, and
Dark side.
have not looked back ever since. I think one of the coolest things about kind of how we do what we do is really managing two businesses under one pool of capital, and that allows us to be really flexible in what we do. And he said when it's good times to buy, especially on the multifamily, that's where we focus our efforts. And on the debt side, it's not necessarily cyclical, but we kind of keep a small, tight portfolio. We've got about $150 million out, give or take at any time. And that's like average deal size is about 5.7 million. That's different than most of our competition. So in kind of the private money, hard money space, most of our competition is doing like fix and flip houses, doing single family development. We focus more on commercial oriented deals and multifamily. So we kind of balance that with actually owning and operating, which helps us when we underwrite a deal for debt. And on the flip side too, when we're actually going out to get our own debt on the things that we own, we actually have kind of an inside track as well.
Well, and over the 16 years, we're not very institutional. We don't like institutional money. We don't raise it that way. We do it with good old-fashioned high net worths. We've been able to buy about over $1 billion of real estate, and we've lent well over 500 million over the years. So a lot more work, raising it at a few $100,000 at a time, but it keeps us with our sleeves rolled up and involved with everything that happens. And we're both that type where, one, we love to grind, we like to do the work, and we're not afraid to get our hands dirty with relationships. Justin knows all of our borrowers very well. They probably don't answer the phone when he calls, but he still knows the number. But I say that in jest. We really do like to work on, it's not when it's easy, right? When it's easy, everything just ho-hum. It's when things don't go right. That's where we, I think, excel. So a little bit about the equity side. Back in 2010, we started buying apartments and we started buying really workforce housing. It seems to be a buzzword today. We did it for a couple reasons. During 08 and 09, that was a real recession. What we're experiencing right now is nothing. people are working, people are paying for things. It's totally different. There were so many deals on the market in 08, 09, and if any of you know what a cap rate is, they were double-digit cap rates, right? I mean, things were really cheap. And what we started to notice walking every single deal in Austin, San Antonio, Houston, Dallas that was on the market was the properties that stayed the most full were where people had to live. It wasn't the shiny downtown high-rises. It was where people had to live. So us being young and really new in syndicating, we figured, look, if things go great, we're all happy. But what if they don't? What if we go back into recession? Well, if you can buy a property where people have to live and you take care of them and they're important to you, they'll stay. If it's stabilized, you collect cash flow. The property pays for itself. That was really how it all started. We thought if we could build communities at these properties, what if we offer after-school programs if we have a lot of families there? Charge them $20 and give the kids tutoring. And so if mom works 2 jobs, she doesn't have to rush home from work because she knows the kid gets off the bus and goes straight to the clubhouse. We do job training. We do English as a second language. By creating these, I call them social amenities, our tenants stayed longer. Well, if they stay longer, our expenses go down because we don't have to renovate units. So you guys can see it's a little different approach. It's a lot more work up front, but retention is what everyone really wants. Less turnover is very beneficial, especially today. So that's kind of our, I guess, secret sauce. It's transformed into a much more sophisticated social amenities program. We actually started a nonprofit that provides these concierge services for very little charge to our tenants. So that's a little bit about the equity side. I think we're here more to talk about the debt side. And debt is great, and I'll let Justin talk a little more about it. But the thing I talk to a lot of our investors, if not all of them. Debt is easy to understand. We're a bank. We're a private bank. We have a first lien, just like your house, right? When you have good collateral, things can get bumpy, but at the end of the day, the borrower doesn't pay you back. If you have to foreclose, you got to make sure the collateral is worth more than that loan amount. And it's not only paper collateral, it's a liquid asset. I always say I love golf. I'm a golf addict. I love playing golf. We don't lend on golf courses. We just don't. I don't care if it's 20% LTV. You can't sell that. But if we're lending 70% of a 20-unit property in Westlake Hills, we'll have 5 bids in 2 weeks. That liquidity is what we're looking for. We're practical. We don't have to worry about bank regulation. So it creates a great opportunity for us, and we can really dig in. We find out everything about our borrowers. We do. But at the end of the day, it's that asset. And to give you an idea, in 16 years, we've had 8 foreclosures total. None of them have lost principal. Some have actually performed better than intended. Our intention is not loan to own, but we will if we have to. You want to talk a little bit about kind of...
Yeah, Adrian covered kind of a good summary of a few things. And anybody that has questions, like we're actually really here to focus on you guys and what questions you guys have about private lending. So if you see something, we may not go into all the details on the deck in regards to percentages of stuff. But yes, sir.
Questions now or at the end?
Whenever.
Whenever. Yeah, absolutely.
Do you have to be accredited?
Yes, sir.
Yes.
And I'll just talk about lending in general. So right now in the U.S., you've got kind of your large commercial banks, your B of A's, your Chases, your Wells Fargo's. They're spread across the landscape. They're really kind of segmented in what they do. They're trying to reach retail customers at a high volume level. Then at the same time, they're really doing large commercial transactions. Everybody kind of in the middle is the one that kind of misses out on getting a good banking experience. Those banking experiences are usually provided by kind of your regional banks. Regional banks are focused more on lending in certain urban cores. They'll do a little bit of residential, but they'll do a lot of owner-occupied commercial real estate. They'll do some multifamily. And then you've got kind of your community banks. Your community banks are pretty well regulated, and they'll do smaller transactions. They'll usually have a legal lending limit only of a couple million up to $5 million. So we kind of find ourselves in somewhere in the mix of all of that. And your non-traditional lenders, you've got kind of what people call hard money or soft money. Hard money really means lending on a hard asset. Soft, I think somebody just said it sounds not as aggressive as hard. So we used to say soft money, but it didn't really make a lot of sense. And so when we went out and tried to figure out the best way for us to really participate in the market and really do it in a way that was fair, not only for our borrowers, but for our investors and also for our operations, we kind of found a niche. And I think this is what he was kind of implying is we do what we know. And we don't do what we don't know. So golf courses, he knows them intimately from being on them, but they're really an operating business. They're really not a real estate business. And so we stay away from things like that. Home building is something that, if you guys live here in Austin, you all, I'm sure, are familiar in, speculative home building and how much that's kind of skyrocketed the past decade. That's a hard one because there's a lot of builders, and it's really hard to understand who's a good builder, who's not a good builder, who's using good trades, who's not using good trades, and most of the competition in that space is doing really high leverage. So we stick with what we know. We know enough about home building that we'll do one or two a year. We won't focus on those, but we'll do it with people we know that we've got relationships with. So as you guys are kind of looking at, investing in that space, no matter who it's with, if you're going to put money in stock with, JP Morgan, you really understand what they're doing, understand how they're doing it. If you're going to go with a hard money lender that's out doing spec homes, just look at their portfolio, see if you can actually look at a comp or two, talk to a borrower, talk to an investor, see how they're doing it. Everything from what their loan documents look like to the loan to values that they're doing. Another thing, I'm getting really in the weeds here, so sorry, if I don't. We say loan to value a lot, but one of the things I'd really point out to you guys is start to ask about loan to cost, because loan to cost is really the thing that's going to help you understand how much room you've got in a deal. So if a guy says, hey, it's worth $1 million, will you lend me, 70% on it, which is $700,000? Well, what did it actually cost you? If it cost him $1 million and he's only going to be able to sell it for $1 million, it's probably not a good investment. If he said, well, I bought the land and it's worth $1 million, when did you buy it? Well, I bought it last week. Well, it's worth whatever you paid for it. Well, I only paid $600,000. Well, then you probably didn't get the deal of the century. So it's a great question to ask. We'll run through a few of the next slides, Jessica, if you don't mind. And these are up here for you guys, and this just talks about how rising costs have affected real estate. Price per unit exceeds the pre-pandemic levels. We'll cruise through these pretty quickly. This is a fun one. Let's jump to interest rates. Holy cow. This is probably the thing that none of us anticipated, is what's happened with interest rates in the last 12 months. We all knew that loans were on sale. Like, we all knew that. Like, if you guys
free
locked
money.
if you guys locked in your mortgage on your personal residence at 3 and an eighth or something, that is crazy, right? Like, that is unheard of. If 20 years ago you would have told somebody they would have been able to get a mortgage for that amount, they would have thought you were insane. When I started my banking career in the late 90s, I was working for Bank of America selling small business lines of credit. Those lines of credit were 9% starting, floating, right? And the fact that a couple years ago you could have got a line of credit for 4%. It made so many deals work because there was what was called an arbitrage, right? So the arbitrage is just that difference between what you're paying for your debt and what you're making on the spread. And so now we've seen these interest rates jump. For our business, it's great, right? So we went from are borrowers paying anywhere from 9 to 10.5, 11%. You know, it's kind of where we were kind of below the rest of the hard money, above your typical kind of bridge lender. And now I think our average is closer to 14% on the same deals, because we do all of our deals floating rate. So we don't fix rate anything. So if you look at a transaction, and multifamily is, I think, a great one. If you guys are familiar with cap rates, you know, multifamily, you know, 2 years ago, you were getting low 3s, low 4s interest, an interest rate. And today those interest rates are over 7%. So if you're buying a $30 million property and you were expecting to get, you know, 25% leverage, the numbers don't work. It just, the arbitrage isn't there. You can't get the rent to justify that. So it's a really a crazy thing.
It's math.
It's math.
And that's how it works. And what makes it so difficult when rates rise up as quickly as they have is that we were so compressed coming out of COVID because so much capital was chasing real estate. They were ready to outbid the next person. So when you can financially engineer deals because you're borrowing money at 3.5%, you can buy a 3.5 cap because you will get some rent growth, and you know that. When you're buying a 3.5 cap and you're borrowing at 5.5 or 6, there's no room there. Everything has to go perfectly if it does. So,
or you've got to put considerably more equity in the transaction. Correct. And so, you know, you start to look at multifamily, for an example, you know, right now you've probably got to put 45% down for deal to actually work with financing. Stabilized
properties right now with Freddie or Fannie, at best you'll get 55% leverage.
Yeah.
So it's not that cap rates values are changing. Debt is changing the market because what someone is willing to pay. When you can buy a treasury for 5.5 with no risk, you have to have something to entice you to buy real estate for it to be more enticing. It was easy when treasuries were at 2-3% and you could clip 7-8% cash flow, right? That's easy to figure out.
You just said Freddie and Fannie are doing 55%?
Pretty much.
Based on what cap though? I haven't done one of those
It's
in a long time.
So the cap,
Let's say you're buying
that's the magic question. What is the cap rate?
It's really hard.
Yeah.
I would think right now in a good major metro, you're somewhere around a 5.5 cap. And it's really based on the amount of leverage or that someone is willing to pay for that, right?
Let's say I buy a true 8 cap. I mean, there's many people on this calculate that. If I buy a true 8 cap or 10 cap, or I carry 8 or 10 cap, is it across the board 55%?
No, and it's per deal because it's
per deal.
debt coverage ratio. They look at what cash is thrown off above their debt coverage.
But Fannie and Freddie, I mean, you know, these guys they're doing large transactions, they're not seeing 8 caps.
Right.
Yeah.
We create our own cap, so we never buy.
Yeah.
Right.
Yeah.
Right.
For sure.
So it's my first house in Circle C 25 years ago, I got a 6.25 mortgage. I was pretty happy, right? It's just now we have a new point of reference, 2, 3, 4, right? So everyone's saying, oh, this is ridiculous. Well, no, pricing got ridiculous, right? Why was an 80s vintage in San Antonio, Texas, multifamily deal trading at a 3.5 cap? Because someone was willing to pay for it.
At $185,000, $190,000 a door.
Right? Was it worth it? I don't think so, but they did it.
You had
right?
a question?
Yeah, I was actually curious because I see that the rates for hotels is much higher.
Yeah.
And I was wondering why.
It's a little riskier asset.
Okay.
It's an operating business. So if you think multifamily is an operating business as well, but there's
our bread and butter.
But there's also not as many like functions in it, right? So an apartment complex in a good location, you can really average out based on market comps how much it'll rent for and what it's worth. easier to operate, easy to find management. Hopefully you can turn tenants a lot easier. A hospitality transaction is very location driven. It's high operations. There's just a lot of things that can go wrong. So risk reward. Yes, sir.
So you mentioned your average rates around 14% right now.
Yeah.
You're basically renting on lending bridge loans.
Yeah.
1 to 2 year,
Yeah.
Okay.
interest only, no owner occupied homesteads, right? It's mainly commercial assets. And I'll give you a great example, which is really interesting. A deal came to Justin, industrial deal in San Antonio. The group wanted to bring $9 million, and they wanted a loan for $9 million. I mean, that's a no-brainer. We would never see that deal. But they didn't want to go to a bank because they wanted to get a new tenant long-term, fix it up, and then go refinance it with long-term debt, right? So we're a good tool, and that's really what it is. To pay 2-3% more in a year is nothing if they can create the value that they really think they can.
Well, and banks have changed their underwriting. So right now, there's much more reliance on guarantees. There's much more reliance on true cash flow. So multifamily, a lot of the small deals we see, they want to have as many tenants move out as possible so they can rehab as many units and flip them as fast as possible. Disrupts cash flow. They don't have a 1-to-1 debt service coverage ratio. Those are the type of deals we'll see because we understand it's better to get the property turned. So
It doesn't scare us, right? And banks have boxes, and if it's not in the box, they can't do it. They want deposits, they want CDs, they want good credit scores. Fortunately, we don't have that regulation. I heard an interesting stat today that it's expected that private lending funds will take about 1.5 trillion in the next 2 years of debt. So we're much more mainstream than we were 10 years ago. When we started to raise capital in 2008 and we talked about hard money, there wasn't a person that didn't say, is Guido coming to break my kneecaps if I don't pay? Right? Now, it's pretty run-of-the-mill private lenders, right? So much so, the Wall Street funds started getting in the market 5 years ago. And they had huge, huge funds. That's when Freddie and Fannie started pulling back. And they were going at 55% leverage over 3 years ago because they wanted somebody else to come in and take market share. The groups that did that in the last cycle was CMBS, right? And Freddie and Fannie were very smart to pull back a little. And the last 3 years, 75% of all transactions were done with bridge private funding groups. So that's why everyone talks about the potential storm that's coming. All of those deals that they have to be refinanced, probably won't be able to be refinanced because the value is different. It's not as high. So there's 2 options. They either bring more capital to refinance or sell it if they can. So that's what is creating a lot of the potential. But I don't know how many of you were in real estate in 08 and 09. We were supposed to have this implosion of CMBS. It never happened, right? There was a lot of distress, but it wasn't near as bad. There is so much capital on the sidelines, well over $800 billion waiting for real estate. Now, are they going to gobble it all up? To be determined. But we have more liquidity outside of the market, interested in the market than we ever have before. That's what's going to make it very interesting. And the beauty is for what we do, we stay in our playground. We like that $5 to $20 million loan. The big boys want 30 and up. Most of the private lenders call it 2 million and lower. We don't even want to play in that space. So it has been a really good niche. And with commercial assets, you tend to have a little more sophisticated borrower, which is nice. And most of them, that is their wealth. That property is their wealth. So they're going to scratch, claw, and fight to make sure that they stay current so we don't take their property. We kind of like that. We're the same way. You got to be scrappy.
Do you have any idea how many times the Fed has raised rates in the past 12 months or so?
11. 11. Never, first time in like over 50 years. And the not only the speed and the amount, but they were in half-point increments too. So I mean, it's been troublesome.
And as I understand it, they just raised one last week and announced they're going to do it again in 45 days.
It's mixed. We had the New York Fed come out today and said they think they're done. Whether they are or not, we're closer to them stopping than where we were.
Yeah.
But if rates stay at this level longer, there'll be more deterioration than they're prepared for.
I mean, this is a, well, it's a big kind of tail wagging the dog situation, right? We all know, like most major metros are behind in housing. Affordability has gotten way out of hand, and this current situation that we're in is only going to make it worse. So, yeah, exactly.
I guess my point when I say is they're not dumb people.
No.
They know that deterioration's going to happen.
Yeah.
They're making these decisions anyways.
But that's the game. Every time we've seen, like, once again, like here we'll use Austin as an example. So, you know, I've been here since the late 90s, so I got to kind of bank and live through our tech bust, right? Which was our first, you know, kind of big market thing after the S&L failures of the 80s, right? It was really the big thing that happened. And it really wasn't that big of a deal, right, here locally. Fast forward to the recession, kind of same thing. You know, locally, it really wasn't that big of a deal. You know, our low was not lower than the tech low. That tech low was not lower than the S&L failures. The high came out even higher. So fast forward to the pandemic, guess what happens? You know, water just gets turned off, nothing's transacting, bottom didn't fall out, was nowhere near the low of the recession. And what did that high do? Just came blazing out. So here we are in another one of these situations that we're fortunate locally. That's why, you know, our portfolio, a great deal of our portfolio is not only in Texas, but is in Austin on the debt side. And, you know, it's just one of those things like, hey, we think it's going to be lumpy and we don't think it's going to be perfect. But if you look at Austin's batting average, it's one of those things, chances are it won't be that bad. And so we just try to weather the storm. So wherever you guys are putting your money today, you know, you can't really do much about where you put it yesterday, it's there. But where you're putting your money tomorrow, just whoever you're putting it with, just make sure that like they're staying in their lane and they've got a plan.
And they've experienced something like this,
Yeah,
right?
we never thought we would see COVID, right? That was nowhere. You know, my high school, you just graduated high school, loved sci-fi. You know, we laugh all the time. He's like, man, this is crazy because it's like a sci-fi situation. You know, and we just talk about the implications of where we're at today because of it, and it really will start to change the way that we look at deals in the future because it's proven one thing: uncertainty is uncertain. Please.
Definite maybe.
Sort of ish.
What thoughts do you all have about hyperinflation?
I'll tell you that I do believe monetary policy is so coordinated that I don't think that would happen. Could it? Anything could. We didn't think COVID could happen. We were shut down for 12 months, right? I mean, you could see the streets in New York, wasn't a soul around. I never thought I would see that, right? Maybe in a movie. So is it possible? Yes. What I'm seeing, and there's not an article I don't read, I want to just devour more and more information. What they've done is working. Some of the high prints of inflation are nowhere near where we are right now. Are there pockets of inflation? Yes, no doubt. But over time, a lot of downturns, it's psychological. If I tell a kid, don't touch that because it's hot, what's the first thing they want to do? Touch it, right? After that, the stove is off. Are they going to touch it? Probably not. So the fear of knowing what could happen, with the news, the headlines, you would think the world's coming to an end. It's not. But people are starting to spend less. People are worried about losing their jobs, right? That in and of itself creates the slowdown. Now, there are 8 people in the US that want to see higher unemployment. The Fed. That's it, right? I don't know if they're dated or not, but something tells me it's better if we have lower unemployment because people are making money and can pay for rent, even if things are a little more expensive. And yet, a lot of it is a little bit archaic. But I'll tell you that when we were hovering at 8, 10, 12% inflation, we're nowhere near that. Are things still expensive? Yeah. But if you think about it, things were too cheap 5 years ago. They were. You could buy a TV for $400, right? So people started to consume. When the supply chain got interrupted, demand wasn't. Well, what happens when you have more demand than supply? Prices go up, right? It's not any more complicated than that. As inventories come to the market and the supply gets better, you're going to see a lot of that demand get met, and you're going to see some of it change. So it could happen, there's no doubt. But I think it would be far more detrimental, and I think politically, they won't allow it. I really do. I don't even want to go into that discussion, but I think there's so much pressure that it's different. We still have a very proactive Fed and monetary policy, and I think a lot more effective than some other countries.
Would you see the Fed stepping in with all these looming bankruptcies and
You know, that's going to be interesting.
fix the problem that it caused?
Yeah, and I think, you know, the very thing I say they, the higher ups, the Fed, the government, and what have you, they claim they want to help the little guy, right? What we're gonna see in probably the next 24 months is the large institutional groups are the only ones that can go out and buy a $60 million building all cash. And they're gonna win all the bids, and they're gonna pick off the properties that they like. The other syndicators, we're gonna be sitting on the sidelines. We're not gonna be able to do it. So they're gonna create the very thing that they say they don't want to do.
Well, it's already happened, right? You look at BlackRock with the build to rent that they've acquired, JP Morgan, the
Yeah.
build to quint that they've required. Like Jamie Dimon came out like a year ago and was like, the sky is falling, right? It takes a few months for the sky to fall. Next thing you know, they're out writing checks. And you know, our tenants, our borrowers, people that you guys know are the ones that are going to be affected by what their rent is and what your returns are. Like, that's just the truth. Will the Fed step in? Probably. They seem to always step in because it's what they can't not do is just let stuff run for a minute.
I think the Lehman crash was pretty unique. And I don't know if any of you read The Big Short. I don't know how many times I had to stop reading it and smash it on the ground because I was so angry at what they allowed people to do, to lose money for investors, create another investment vehicle, buy the debt at 10 cents on the dollar and sell it and make money when the other investors lost all their money, right? And that's what they created, right? So,
well, actually, it's you know, this is actually the next slide in the deck is you look at why private lending, you know, is becoming more in vogue, right? We just saw some banks about to fail, and the government step in. And I don't know if that's actually the next slide or not, but
if it is, I'm impressed. You actually looked at it.
I can't. My side vision isn't that good, but you know, that's what we saw, right? We saw this run on banks that didn't actually need to be run on because of fear, really because of fear. And then the Fed came in and said, you know, hey, we'll save the day. And the government said, hey, we'll do something about it. Please.
So hopefully on a brighter note, in one of the slides it said that your lending fund one was realized of 10.91%.
Yeah.
I'm guessing whatever lending fund 2 or 3 or whatever you guys are at right
Yeah.
now. is different percentage because right now you're lending at about 14%. How do you expect those returns to?
Good question.
be for-
We're thinking 9 to 10%, somewhere in there. Fund one had a couple foreclosures that we sold and did really well.
Actually, they weren't foreclosures. They were sold before they were foreclosed, and we actually were able to collect some pretty hefty fees by helping work those out.
So
And
it could happen in Fund two.
So those actually had some interest rates that were effectively like 18% that we were able to collect on. And it was towards the end of that fund, which was a nice little pop, and we had really good loan to value because, had we actually, we're glad this happened because if we would have foreclosed on them, we would have never actually got them because somebody else would have bought them. So.
The other thing is this fund has been a part of 2-3 years of very low interest rates. So that we're floating on everything that we do. So if we want to lend, we have to adjust to what the market's willing to pay.
And one of the things, the conversations that we've had in the last few weeks is what is our threshold on where we'll allow our rates to go? Because the thing that we don't want to do is we don't want to charge so much
That we choke the borrower.
That we choke the borrower. We are not a loan-to-own shop. We are a rinse and repeat lender. And what I mean by that is we want to, raise money from investors, deploy it through good loans, get paid back, lend that same money out again. That's how we want to do it. We think that's the best way. So we don't predict the returns on our funds getting up to 12, 13, 14% because, if rates keep going, we're going to have to actually, like we've talked about lowering our rates for some good borrowers so it doesn't choke their cash flow.
Right.
So they can pay their property management, so they can pay all the things that they need to pay. Yeah.
And there are lots of groups that they're loan to own. They know it and they're prepared for that. Our capital being high net worth, we're about risk reward. And if you can make 12%, but you're taking a lot of risk, or you can make 9.5% and take a lot less risk, I'll do the 9.5 personally. I don't need the risk, right? If we're going to do risk, let's go do equity deals and really turn around a property. Take it when it's 10% occupied, redo the whole thing, then you're going to get paid for that. So it's understanding who the lender is that you guys want to look to invest with, understanding what they're doing. How do they underwrite? What do they like risk? Our risk profile is probably very different than you guys.
Well,
And
I think to stick where you were going with, let's look at the bright side, right? I think this is a market opportunity. And I think this is an opportunity for borrowers, lenders, and investors. And the reason is it's hard to get a loan right now, right? Properties are, if you can actually show up and close on something, you have an advantage. Because if you say, hey, I can close quick, I can really close, that's an opportunity to buy something this is probably the closest that we may see the next 12 months on anything being on sale, if you will. So that creates an opportunity for borrowers. That creates an opportunity for lenders like ourselves to actually lend on those transactions. And for you guys as investors, it's actually a pretty good place to be. Find a good lender, to his point, find somebody that's doing their due diligence. We don't do any equity in our debt fund, but this is also an opportunity where you guys might find things where you find a good deal that somebody says, hey, we've got debt lined up, but we need some pref equity, we need a little bit of a piece. That's really where you guys can see some upside because the market's disjointed.
On the debt fund, do you just make money on the spread, or how do you guys make your money?
As Thrive Lending, so a couple ways. One is we do charge an assets under management fee. We charge the borrowers a loan origination fee, and then we do all of our servicing in-house, so there's a servicing fee that we charge.
we do 6%, 100% of the first 6% goes to the limited partners, 70% any cash flow above that goes to limited partners, 30% comes to us.
So we get a little kicker
The
as things
effective
perform.
rate is, what'd you say, about 10 after all that's said?
9 to 10.
Yeah.
What platform are you using for servicing?
So we use a software called Mortgage Office, and that's how we do all of our billing and stuff. But our servicing department is in-house. We tried 2 or 3 different servicers over my 8 years there, and we decided, since I was actually a banker and knew a little thing about banking, and our loan servicing, she came from a bank, so we just decided, when you use a third-party servicer, all they do is send out a bill and tell you when somebody didn't pay the bill. And our loan servicing gal in our office, she has everybody on speed dial, and it's like, hey, your payment's late. Just is everything cool? And so she talks to people multiple times, and she'll give me a heads up and say, hey, I just spoke to so and so, and here's the intel. And then the first thing I do is I text them and say, hey, have time for a conversation later. And so we're very actively managing what we do. So the cool thing about our portfolio average loan size of 5.7 million, 130, 140 million out, we've only got 20, 25 loans, right, at any given time. So that allows me to know every single borrower. I have set foot on every single project that we have lent on. I've shook hands with the borrowers, looked them in the eye. I have their mobile numbers. We text. He made a Guido joke. I am Sicilian, but that's the level of which we operate. There's nothing that's foolproof. But one thing is, if we get to know their character and how they're going to react, we can at least anticipate what we need to do.
And I like to tell everyone, we do have defaults. We have people that we know pay on the 18th every month, not on the 1st, because that's when he gets his draws from his development projects, right? So by knowing and building the relationship, you can work some of these things. They're not perfect, but we manage the imperfect pretty well. Yes, sir.
Do you have redemption or liquidity for your debt fund? Like how
It's a 2-year lockout.
Okay.
After that, 90 days.
So every 90 days you offer.
Yeah, if you want to redeem, you give us a little time. The only way we can redeem capital is if a loan pays off. That's what creates the liquidity. So if we have 20 performing loans and we have 15 million in redemptions, we're not going to call good loans because of the redemption. The really interesting thing is, because we do 12 to 24 month loans, that tends to roll pretty good to create the liquidity events for the redemptions. An interesting thing is, as of late, our loans have been staying a little bit longer on the books because borrowers are trying to figure out what they want to do. Do we want to sell it? Do we want to refinance? Can we refinance? So that's been a little bit different than the norm of years past, but we're pretty good at adapting. So unless you're coming in, which would be great if you come in for 5-10 million, that'd be awesome. If you have lower amounts, a couple hundred, 500, we can redeem that pretty consistently because we always have new capital coming in at the same time. So it creates that.
It's a cash management business. So to his point, as loans mature and pay off, as new investors come in and subscribe, there's just kind of a little bit of a window. And what we try to do is we try to keep actively lending. And we've had a few redemptions, but after 2 years, give us a heads up if you have a life situation that you're in a pinch. We have the ability.
Quick follow-up there. So it's an evergreen fund that is no longer. Okay.
It is. It gets, if you want to get a little more detailed, if it comes in the middle of the quarter, you make a flat 7. If at the start of the next quarter, you're now a fund owner, and at the end of that quarter, you get to share in the 70-30, which gets the return up.
Sounds like you pay quarterly.
Correct. And the other, I like it. I have a lot of my money in the debt fund, personally. You can reinvest your quarterly distributions to compound it, which is pretty awesome if you can do that. I don't want to see it. I want to just keep growing. That's what she said.
Jessica, I'm lost in my package. My staple came
No,
out.
we're on a roll.
Are we on a roll? So I'll actually come out here so we can see over. Oh, risk mitigation. Man, I think you mitigate all your risks before you go into a loan. truthfully. It is, and I can't read her slide because it's really small in here too, but our process, we get deals from multiple sources. So we'll have CPAs that call us and say, hey, I've got a client that needs some liquidity. We have loan brokers that call us. We have bankers that call us. And that's really where kind of the risk mitigation starts is, hey, tell us the story about the person that you're going to refer to us. And then we immediately, when I'm on the phone with somebody, I'm on Google and I've pulled up the address. I'm looking at what surrounds the building. I'm Googling their name. I'm looking them on Instagram. I'm just really kind of building a quick case to say, hey, is this somebody on the surface? Is this a transaction, a piece of property in a location that we'd like to lend on? And if that checks the box, then the first thing we do is really talk to them about brass tacks on what the structure of the deal is going to look like. So before we underwrite them or anything, we kind of say, hey, if we had to own this piece of property, how would we want to own it? What do we think it's worth? What kind of pricing would we put on the deal? We don't believe that you can outprice risk. You can charge them 40% interest, and it's not going to reduce risk. The more you have to charge them, probably the less likely it is that it's going to be a good transaction. So that's where we start the risk mitigation process. Once we agree with a borrower on terms, that's where I'll physically go out and meet them in person. I'll walk the property. Depending upon the property type, we'll determine if we get a third-party property inspection. Sometimes they're very involved. They take a long time. We get surveys. We get environmentals. We get their personal financials. We get property financials. We pull a background report. We get appraisals. We also get broker's opinions. So we take a broker's opinion and appraisal. We contrast the two. If there's a delta that's more than about 10%, we'll probably go get a third opinion. Most of the time we are using an appraiser that we've used before or a broker that we have a personal relationship with. So we can really get like, hey, if I call you back and you need to sell this thing, what's the fire sale price?
What's the fire sale?
Yeah, and that's what we really use to set our LTV. We confirm what their loan to cost is. We confirm their liquidity. We look, did you pay your mortgage? Man, if you don't pay your mortgage, chances are you're not going to pay us. You got a AT&T phone bill that's late, that's probably not a big deal. A medical bill that's late, probably not a big deal. We kind of forensically look at that stuff. And then we get with our attorneys and we make sure that their entity documents are good. We look up the Secretary of State. We work with a good title company. Our attorneys draft all of our loan documents. We review those in-house before they go out to the borrower as well, and we close at a title company. And that's where the loan closing starts, right? And then there's further risk mitigation. So it is, hey, did they make their first payment? Did they not make their first payment? Even our borrowers that pay on time, I probably talk to them at least every 45 days. Hey, what's going on? Where are you at in your process? Where are you at in your business plan? Some of our deals, we don't do a lot of ground up new development, but we'll do 1 or 2 deals a year. And we've got a couple of case studies that we could share with you guys on those. But if it's new development, we did a hotel. You're like, hospitality, it's risky. So why'd you do a hotel, right? Well, not only was it a hotel, but it was part hostel. It gets even better. And you're like, well, why would you do that? Where was it? It was in Portland, Oregon. Why would you do that? It sounds crazy. And it was, but it came from a broker that I've got a personal relationship with that I've known for probably 5 or 6 years. And he called me and said, like, hey, there's a story here and I think you'll like it. And so sure enough, had the conversation, flew out there, met with their developer, met with their equity partner. So their equity partner was the reason that was the cherry on top of the deal. Their equity partner agreed to a minimum liquidity covenant and also to put $2.5 million in a Wells Fargo account that was in escrow. So all of a sudden our loan to value just got better if he defaulted. And this was a loan that happened in the pandemic. So we've got a hotel in Portland which was severely affected by the pandemic, under construction, midstream, with contractors that can't come. I've got a third-party inspector that I send out there. He wears his mask and literally walks the building. He's like, yeah, everything's here. This is exactly how it says.
You experienced something like that?
Yeah. And we figured out, we all sat around, the 3 of us, and kind of, I think we fought between the 3 of us, like, what do you do?
Do we stop funding the draws? Do we keep funding the draws? Well, the asset is worth more if you fund it and
Right,
you
if it's
complete
finished,
it,
right?
Right.
You know, can we get contractors back out there? You know,
But the icing again, the beauty was he got the guy to put that amount of money in an escrow account to create some safety.
but we also called him during this
Yeah.
time. We're like, hey, what do you want to do? Like, what is your business plan? What is your model? We finished the building, what are you going to do? So we stuck it out, you know, great third-party construction
And they
inspections.
refinanced it.
And they got us refinanced within months of
I couldn't
completion.
believe it.
Yeah.
Yeah.
Yeah, I mean, like sometimes like you structure the right deal, you have the right players, it makes sense. So risk mitigation in that one started at the beginning. It was a good story with good borrowers, you know? So what else you got? This is multifamily over in Clarksville. And this is one that you probably have seen their signs. I will leave them nameless. You'll probably have seen their signs around town, but they're an active multifamily player in this market. We've done probably $60 million worth of deals with this group. And it's because he can call me and I can quote him over the phone and I can guarantee him that we'll close because we have a relationship.
We've
And-
closed in 48 hours.
Yeah, and he's,
If we know the asset, we know the borrower, it makes it a lot easier.
and surprised we mentioned we might do a little bit of multifamily, so these are really easy for us to
But
understand.
his MO is that he likes smaller properties, older, and he goes in and does some massive rehabs and does really good job.
So we'll push so you guys see this is one of our highest loan to values in our portfolio. And the reason we'll do that, it's a multifamily property in
In
Clarksville,
Austin, Texas.
right down the street. So those are ones that we're like, hey, yeah, we'll stretch on that. So, you know, banks wanted to give him 65%, and they wanted to do a forensic, you know, analysis of all of his underwriting and everything. And you can imagine if the guy owns, you know, a couple $100 million worth of multifamily, how long it's going to take them to underwrite him, right? He's like, I just want to close. I make more money if I get this thing closed and rehab.
And then he goes and refinances a portfolio with the long-term lender and pulls out his equity and is really happy. So it works great. In that $60 million and however long we've been lending to him, never missed a payment.
Never been late.
So
Not only not missed a payment, never been late. So, which is kind of an anomaly in our business. So, yes, sir.
The asset test question, have you ever paid a capital partner late, ever, their payments?
We ever paid a capital partner?
Like, someone who's providing money to you guys,
One of our investors.
investors, yes.
we've adjusted distributions. During COVID, we adjusted distributions. Right now.
Not on the equity side, I should have said on the debt side.
No.
I think so.
We've paid less than the return, the 6%, but no.
So
we
that
still
was,
pay
that,
it.
that was actually that fund one. We had it was a preferred return, so it would accrue. So when we were coming out of that fund, we had those big foreclosures that we talked about that were actually pre-foreclosure. Those did a drag on our cash flow for 2 quarters. So we accrued part of the preferred return there. And but they got made more than whole at the end.
Yeah.
So that actually I think is a really good point when you guys look at you know, any type of investment that's in a fund, right? One of the upsides is it's diversified, so you're against a whole portfolio. But one of the things is especially in private money, cash flow can totally be disturbed. Depends where you're at in the cycle, depends where you're at in the size of the fund, depends on the deals as well. So
And
that was
that's
a
why
great
we
question.
limit 20 million. We don't want any one loan taking 50% of the fund.
But I think that's what we got for you guys.
Excellent.
Any other questions or thoughts, or
Well, thank you, guys.
are you sure? Maybe?
It's good. Like,
You're Polish, Adrian, right?
The last name is, yeah. I don't know if that's good or bad, but yes.
I looked your bio up.
Yeah,
Was-
Polish Argentinian, believe it or not. How's that?
I had to-
Raised in Houston, so kind of crazy.
#1 diverse city.
Yeah. Thank you.
Awesome.
If you do have any questions, let us know. You can email us. We can talk a lot more in detail. I'll probably be the one to speak with you guys, but I can go in much more detail about debt and equity if you so wish.
Cool. All right. Thank you.
Thank you. It's kind of cool. Can I take it?
All right. Do you guys? All right. Thank you, guys. We'll run through a couple of announcements, but we always appreciate the great education that we have, a lot of crowd interactions, always great. So thank you guys for all the questions as well. So now I just, of course, want to give a couple of announcements here. And then we will allow for some deal pitching and networking. But right now we have a really great promotion going on. It's called our Double Rewards promo. So pretty much what this is saying is if you guys want to open an account, or if you know somebody who wants to open up an account, you will actually get a credit towards the account. So usually it's $100 to get started. You will get a $50 credit, so it pretty much makes that account about half off. So that's a great opportunity if you're looking to get started or know somebody that might be interested as well. We also have our Gold Family plan that we want to share with everyone. This is a plan that allows for multiple accounts. It's kind of all pooled in. It takes accounts maybe that are yours, maybe if you have a spouse, family members, you know, that maybe children or grandparents, something like that. You can come together and all be on this plan. There's some great benefits. You get a designated account rep and a fee structure that is all inclusive. So it kind of takes away some of all the line by line fees that you would see in a transaction. It really is. It's a great way to kind of keep everything all in one. But you get things expedited, you get extra events, you get more perks than you would get with normal. So we like to share our Gold Family difference with everybody. If you don't have any plans this weekend, we would love to invite you up to Dallas for our Elite Multifamily Summit, where we're going to be talking a little bit about the current state of the market, some financing options for multifamily, what you kind of need to be aware of, and some case studies over the recent years of what some of the investors that we know have been seeing as well. So that's going to be a really great event. We do have coupon codes, so the tickets are only, I believe it's $52.50 with the coupon code. So it's a really great deal for a full day of education and a happy hour as well. You get lunch included as well as free drinks in the evening. If you would like to join us for our expo, it is returning. So next summer in June, at the very end, we are going to be bringing back the Quest Expo for 3 days, full of education, full of fun, full of networking, and with a lot of new perks that we're trying to throw in there as well. We're going to have our American Dream Party, which will have a lot of fun games and a happy hour as well. But we're bringing new speakers, new content, and new panels to this, so we know it's going to be really awesome. If you are interested in maybe sponsoring or speaking, you can come and speak to myself or some of the marketing staff in the back. We've got some information for you. But without further ado, if you do have any questions, feel free, scan this QR code, get a consultation set up, or you can come and talk to myself or Chris or Juan or Megan in the back, and we can help you out as well. But again, thank you for coming. Yes, do you have a question? Oh, man. We have not. No, you're right. I think there's just a lot of great opportunity in those other two cities, but we will be bringing a small, like, half-day boot camp to the San Marcos area for our Austin and San Antonio clients. So do be on the lookout for that. Just as a reminder, we do not have the social next month. It will be going to quarterly, so we would love to invite you out in October. But if you show up on the second Tuesday of September, we will not be here. The doors will be closed. So we don't want you guys to show up without us here. But again, thank you guys for coming. You can always check us out on YouTube if you want to catch the replay. Like I said, if you have questions, come and talk to us in the back. And then now, as you saw our little disclaimer here, is our time for deal pitching and networking. Of course, we can never endorse or sponsor anybody. We encourage everyone to do their due diligence. But if you would like to come and take the mic from me, feel free to come and do so. If you have a deal or if you have a service, you can come and pitch that in front of the audience. We do have people online as well, so be sure to say your phone number and your email address too, so those people online can maybe do a deal with you. So does anyone want to take it away?
Hi, everybody. My name's Chris. I'm with Gold Coast Ventures. I'd like to say I really appreciate their talk. I think the economy is in deep waters, but Adrian was saying, anyone who survived 2008, that's like surviving boot camp, and you just know on the other side of it is a huge upswing. So I really do appreciate their perspectives. I'm with Gold Coast Ventures. We're a Houston company that does home flips and new builds. We've been in real estate for 17 years, but we've been doing flips and builds for 9 years. We've done over 60 projects. All have been backed by an investor or a lender. All have redeemed successfully. We've never had a bad position with any of our investors, any of our lenders. A couple of things the gentleman said. When you're looking at builders, you want to see how good their trade teams are. Our trade teams are excellent. We're Houston-based, but we take our trade teams into Galveston. And if you go into Galveston, you're going to pay a premium there. But that's why we bring our trade teams in from Houston. We don't pay the premium. We produce a great product that stands up in Galveston. So our trade teams will follow us wherever we want them to go. And then the other thing they said is that you always want to look at the debt ratio with these builders, and on one of our projects right now, we only need a $50,000 investment. So we passed the test on both of those marks. But in general, we're not a big builder. We've done, like I said, about 60 projects over 9 years, and we've only been in good standing with all of our investors, all of our creditors, and we offer an above-average rate of return for funds, backed by the only thing that Texas real estate. Backed by Texas real estate, which the only thing better than Texas real estate is gold itself. And so we're looking to increase our capacity to build. And we specialize in the Houston Heights area, which is an urban area of young professionals. Anything there in the $500,000 to even $700,000 range does not last long. It goes quick. We have a project going on in there right now. We have a project in Katy, and we have one coming up in the Memorial Katy area. So if you are looking to earn an above-average rate with an established company, with a good track record, secured by Texas real estate, we'd be happy to work with you. Yes?
And it sounds like there's no accreditation required for this.
No, there's no credit. No, accreditation, I think that there's a certain limit, right, and I think we're well under that. But yeah. So I'm Chris with Gold Coast, and good to talk with you. Thank you.
Well, I don't have any deals for you guys. I have a tool that I would like to promote. I have created a calculator that showcases what it's like to invest in syndications or any other investments that kind of return regular returns. And you can find that at WealthSyndy, so that's WealthSyndy.com/calculator. And for those of you who are online, if you're going to the Elite Multifamily Summit, I'll be there. And if you see me, say hi.
Got a couple more here.
Hi, everybody. My name is Kui. I'm with Versatile Global. We have a private equity fund. Our team composes of me and a few others who've been investing for close to 20 years, and we started like you guys, and some people here that I've talked to, doing single family, and then building, then commercial projects, and we're at a point where private equity because we're always short on cash and we find a lot of good deals. And the difference between our fund and a lot of different funds is we're very well diversified. We have a lending side that can pay prefs from 6 to 10% plus profit sharing. That's pref is the guaranteed, just like Adrian was talking about, 6 to 10% depending on which tier you invest in. And then we have the development side, which gives you a huge upswing for the profit sharing. But I can give you more details. Contact me in the back. Thank you, guys. Which business? I've been in real estate investing since 2005. Some of our partners have been investing since 2007. Each one of our commercial properties is a different entity. So we do that for asset protections, but really the majority of our people have been investing from 15 to 20 years.
Right, but what you're offering right now, how long has that been going on? 6 months, 2 years, 5 years?
That fund started this year as a result of us trying to balance between our notes and our developments, because what you guys are going through is probably the same as us. Every project you find, oh, let's hurry, we got 3 months to close this, and we're just running like crazy. Versus now, what we're doing is we're balancing that between the fundraising, we're getting our prefs paid to our investors so the money is stable with the cash flow so that we can use that to fund and close the projects and then have the time to close the deal with the banks. So you are correct. That fund is new, but that's based on the experience of quite a few of us who's been doing it for a long time. We're just looking for a solution, and we found that solution. Any other questions? All right, thanks, guys.
Alrighty. Well, then, if we don't have anybody else that wants to come up, we'll go ahead and wrap up for the evening. Feel free to stick around, network, grab another drink, a piece of pizza. The more you guys eat, the less we have to throw away. And we will see y'all in October for the second Tuesday for the panel. Thank you, guys.